Welcome, ladies and gentlemen, to the session this afternoon. My name's Andy Critchlow. I'm head of news at S&P Global Commodity Insights. I'm delighted to be moderating this session this afternoon on what really is probably one of the most important resource questions and subjects that the energy transition is going to face and have to grapple with over the next 20 to 30 years, and that is about ensuring future critical mineral supply chains for the world's new clean energy players. And I'm delighted to be joined on the stage by a fantastic expert panel to go into this subject today. Gouranga Sen, Group Head, Economic and Policy Analysis at Vedanta Group. Henry Van, Head of Industrial Metals Analysis at Trafigura, and Siddharth Natyal from Lohum Corporation here in India. So much of what we're talking about in terms of energy transition, decarbonisation, the pathway to net zero, renewable energy, sustainable energy is dependent on the supply chain, investment, and demand for minerals such as copper, lithium, graphite, zinc, critical minerals, critical metals, battery metals that are going to power this energy transition. And just to set the scene, I'm going to come to you first, Henry, on this. Can you just give us an idea of what the challenge is around demand growth globally for some of these classifications of minerals?
Sure. Thank you very much for having me today. So there is a big challenge going forward over the next 10 years regarding supplying the growing demand need for these critical minerals. And the reason really is because of two main big demand trends that are really kind of coming in together that's going to drive the demand for these metals up significantly. The first is the energy transition, right? The fact that we're making new energy systems, and these require a lot more difficult and complicated infrastructure than more traditional energy systems. The more complicated and difficult infrastructure that's needed, for example, more grids, more batteries, that equates to more metals consumption. So that's the first point. The second point is growing economic development across a lot of the developing world. And I think India really is the forefront of that growth right now. To put that in context, demand for metals in India is growing at roughly 15 to 20% year on year. This is massive numbers, and we expect this growth to continue over the next few years. So kind of putting that all together, we expect the demand for, let's say, more industrial metals, right? So this is metals like copper and aluminium, to grow by roughly 50% from these current levels over the next 10 years. And the demand for battery metals to grow by even higher than that, more than doubling or tripling the current levels, right? And if we put that into perspective, then what that means is that right now the current capex that's being deployed for these metals is not sufficient to cover the demand gap in the next 10 years, right? Right now, roughly, mining capex every year is about $50 billion a year. We expect that actually to meet the demand requirements, it needs to rise to about $75 billion a year, right? So you put that as a capex gap of roughly $250 to $300 billion over the next 10 years. Now, that seems like a lot of money, but if you flip it on its head, the upstream oil and gas sector has $500 billion of capex per year, right? So actually, compared to how much capex is being deployed in the oil and gas sector, the capex gap is actually not so big in relative terms. But still, it's something that has not been done yet. There's still a lot of new capex that needs to be deployed and a lot of new demand that's coming on that we see in the market right now that needs to be filled by new supply.
Gouranga, if I can come to you next, how do you see, I mean, Henry painted a very bullish picture there. Are you as confident about future demand across this value chain of metals?
If you see the critical mineral demand, which is actually deriving from the downstream industries, for example, EV or solar energy or wind, those are growing at a massive scale. if you see EV, even after having so much headwinds in terms of inflation or elections or high interest rate, even in 2024, the EV sales grew by 25%. And we are now selling almost 17 million EVs every year. And if we go by IEA's estimation, by 2030, we'll have almost 45 million EV sales, and which is likely to grow by already to 65 million in 2035. So there's a huge demand is going to come from the battery also. So as the EV goes, the battery demand is likely to quadruple from 1 terawatt to almost 3.8 terawatt. So there's a huge demand for battery sector is coming. If we go by the renewable energy, for example, solar. So this year we achieved 2 terawatt solar capacity. And it took almost 68 years to attain the 1 terawatt of solar capacity. We achieved this in 2022. And it took just only 2 years to add the next 1 terawatt. And the International Solar Association, which is expecting it, that by 2030, another 4 terawatt hour of solar capacity will be added. So it's a huge demand is coming from solar photovoltaic panels, and that will give the boost for critical minerals like aluminum or even copper. And as the battery sector grows, then that is going to give the boost for the demand for nickel or graphite, even lithium. Wind energy is also going in the same direction. So I'm pretty sure that the battery mineral demand, even the transition mineral demand is going to explode. As per IEA, it's going to double actually, and I think it is all still on the lower side. So almost 2 to 2.5 times of demand for this critical mineral is going to have. But the demand scenario will not be linear. Even if you see within the critical mineral demand and supply balances, we are going more of less cobalt-oriented demand for battery. Even if you see the nickel, as we move for the direct lithium extraction, that is going to happen and reduce the demand for the lithium as well. So within the battery chemistry, things are changing. So that is another way, just a challenge basically. Even for the rare earth, we are moving towards a magnet which will not require any NdPr. So substitution effect is also coming, but going by the international policies, which is more towards developing the renewable and the clean energy, I am very hopeful that this sector will explode.
So a sector exploding, and I think that we saw a sign of that last year. Of course, at S&P Global Commodity Insights, we often look at commodities through the prism of our price assessments and our benchmarks, which we're known for globally. And if you look at copper, we hit a record high last year of $11,000 per metric ton. I'm going to come to you now, Siddharth, on this. How sustainable is this market for critical minerals? Is it a bubble, or do we see long-term investment growth going forward?
Great question, and something we grapple with because our business is predicated on refining and selling a bunch of these critical minerals. So we've been through a bubble. We've seen lithium prices, LCE prices at $50, $60 a kilo. We're seeing them at $9 a kilo now. We've seen cobalt jump up and be at $15 now. Copper is still doubling. I think copper is the one exception to this rule in terms of prices and how they've moved. But we have been through this. So there are two different parts. Is there demand for these products going forward in terms of tonnage? And second, how does that demand translate into pricing? On the pricing bit, frankly, it's our job to make sure we make money at every price. Some of these prices seem very low to us. Some of these prices we think that in the next 3 to 5 years should increase. Prices of lithium, of nickel, etc. Prices of commodities like copper, and I'm sure Trafigura might have a better sense than I do on this one, seem to have jumped far and fast for good reasons, because of supply getting off the market, etc. And maybe when those supply constrictions go away, we will have prices come a little bit more stable. But the broader point on the demand is something we are extremely convinced by. So Gouranga mentioned this, Henry mentioned this, but if you just look at India, in the next 5 years, if we're adding 500 gigawatts of power installed capacity, that's another 1.5 million tons incremental copper demand, another incremental 21,000 tons of REE demand. If you're adding 5 million tons of green hydrogen, that's another 5 tons incremental of PGM demand. If our PLI scheme, the incentive for producing batteries in lithium ion, if that goes per plan, then we should have 50 gigawatt hours of incremental capacity in lithium ion batteries in the next 5 years. That'll add another 3,000 tons of lithium capacity demand, 7,500 tons of nickel demand. So these are all moving in the right direction. And India's supply addition in these areas is between 10 to 20%, in some cases 5% in batteries, for example, of global supply addition that's happening. So the broader trends of overall demand for these products increasing is something we're super convinced by. Prices going up and down, and we've realized we're not great at timing that. We make do with what we have.
You gave a sense there of the volatility, prices going up and down, and we talked about this, prior to coming on for this session. If you look at the lithium price, Platts assessed lithium hydroxide, CIF North Asia last year in 2023 actually, in $24,000 a metric ton. Now we're $9,500 a metric ton. Henry, I mean, what explains that volatility for you in that particular market?
I mean, it's really representative of a market that is growing extremely quickly, not just in terms of the consumption side of the story, but also the supply side of the story, right? So if you take lithium as an example, right, you start getting a lot of EVs penetrating the market globally in the automotive sector. That then springs a huge increase in the demand for batteries. That then brings on, the price goes up. That then brings on a huge wave of new supply. And then the supply then eventually overtakes the demand, and then you end up in the situation right now where the lithium market is very oversupplied relative to the fundamentals right now, right? Now, there's a bit of a circular loop there where, because lithium is at the moment in a relative oversupply, what that's done is reduce the price of lithium and then in time reduce the price of batteries, right? And having listened to some of the panels today, one of the things that everyone keeps talking about is the low cost of batteries. And in my mind, a big reason why batteries are so cheap right now is because the lithium price is cheap right now. And so the cost of creating another battery right now is relatively inexpensive compared to a few years ago, right? The kind of positive feedback loop from there, which I think we'll start seeing in the next few years, is that as battery prices are low, that then creates new demand for batteries, which then increases the demand, and then we'll probably start spurring the cycle again at some point in the future to basically incentivize lithium prices to go up as people realize that more and more and more uses of batteries can happen, right? That not only is there just more capacity being brought on, but that technology advancements will happen where you can basically use a battery for more duration than you can right now. So I think particularly with the battery metals, what we're seeing is a real step change in people trying to understand really what are the use cases for this technology. And kind of overall right now, the trend is very much towards more uses for this technology instead of less uses for this technology.
Gouranga, on this issue of batteries, I mean, is it fair to say that India has fallen behind a little bit in terms of battery manufacturing and establishing a robust supply chain of batteries that would feed into EV demand growth in India?
Do we agree to some extent that India is a late starter in terms of battery manufacturing and securing the critical minerals? But we are going very fast in terms of securing the critical mineral as such, and the entire value chain for the critical mineral, even downstream. So in the last 2-3 years, there was a huge change in the policy perspective for the critical minerals. It started with allowing the private participation in the exploration and mining of some of the critical minerals, which were not allowed earlier. But with the changes in the MMDR Act in 2021 or 2022, the private participation has been allowed. Then it came with when we opened up the offshore mineral also. So going beyond the land area, participation is allowed in the exploration and mining in the offshore areas. So, and there is a huge area of supply is unlocked, needs to be unlocked over there. And we have also a pretty good system for incentivizing the exploration through the National Mineral Exploration Trust. Anybody can have that fund and utilize in the exploration. So it's rising. The investment is also rising. As we talk about the downstream value addition, yes, we have also the system of PLI scheme. There is a production incentive scheme has been announced by the government, and there's a huge encouragement is coming from that way. And investments are also been coming, particularly in the ACC batteries, as well as the EV manufacturing setup. So things are catching up very fast. I'm hopeful India will emerge as a huge manufacturing hub for solar as well as battery manufacturing and the EV manufacturing. And we are also securing the supply side as well. So we have a system called Kabil as the Khanij business. There's a joint venture between the three PSU companies. The mandate is to scout for more critical mineral assets overseas so that we can supply it to India, back to India, and do the value addition here. So I'm hopeful that India will emerge as a big critical mineral players.
So, in unison with critical minerals, there is a discussion, in parallel really, that is to do with energy security. And it is implied that a shift to electrification that creates the demand for critical minerals, that it guarantees more energy security than economies that are dependent on fossil fuels, imports of fossil fuels. But it seems that it's not necessarily the case when you have tariffs imposed. You have a new US administration that seems to be pursuing this economic strategy. You've got growth in protectionism globally. You've even got a suggestion that certain countries could be annexed because of their wealth in some critical minerals. As an investor, as a market participant, Siddharth, how much of a concern is it for you when you hear some of this?
So to be honest, all of us have lived in an environment where tariffs have only gone one way, which is pretty much down. It's only in the last few years we've seen a trend the other way. So some of how this plays out is still ahead of us. I think we have to still see how that happens. But there's a few things that we can certainly do to de-risk ourselves. One is the entire idea of circularity. If the numbers we've done are right, by 2040, if we really get our act together on circularity, the majority of materials that go into the EV supply chain should be from secondary recycled sources. So when you have that happen, then you have each country or each set of similarly aligned countries actually control their destiny a lot more than in a market where today, for example, one country controls between 35-40% to 85-90% of all critical minerals. Right? That is an extremely risky situation. That's in a situation today with no tariffs. This is a country that can turn the tap on or off at will, and in the past has. So if countries like India can start this process of reusing what we have already, there's no reason why within a decade and a half, the vast majority of what we use should not be in a closed loop. And when that happens, certainly tariffs become an irritant, but they don't become something that's existential. Now, despite that, I think also economic interest rules. So I'll give you the example of Europe, for example, which recently came out with rules saying battery scrap should be recycled locally. It's been classified as hazardous material, cannot be shipped except to OECD countries. Now, India can recycle NMC battery scrap at $1.50 per kg. In Europe, I estimate those prices are 3 to 4x, so which is, call it $5 to $6 per kg. Each kg is 5 kilowatt. Each kilowatt hour is 5 kgs of material, right? So on a per kilowatt hour basis, we're talking about a price delta between India and Europe on just processing cost of between $10 to $20. In a situation where the new cells sell at $70 a kilowatt hour, if the processing cost delta is $15 to $20 per kilowatt hour, how does this industry survive? Either the European customer pays a lot higher price for this material, or the European Union subsidizes this. I think at some stage soon, some of that economic rationale starts percolating down to the discussions. And we will have Mr. Ricardo back in the theory of comparative advantage, where aligned groups of countries will figure out how do we apportion comparative advantage-based solutions, where India does a bunch of this recycling, which we do well of, and similar areas where costs and talent become important. And we can leave the cutting edge innovation lead in that can be taken, as it has been in the past, by EU and the US, and that percolates over time as well. So a longer answer, in the longer term, I think recycling allows us to get past the issues of what tariffs might cause. In the medium term, I think just cold-hearted and cold-headed economic analysis will suggest that some blocks of aligned economies will develop. Within those, there'll be freer groups, but there might be blocks that don't talk to each other, and their issues might emerge.
Henry, how do you tackle that? Do you see, risks from tariffs, protectionism, policies like CBAM being of greater impact to the critical minerals market than, some of the issues around choke points? We talked about Congo, the opening up of the Lobito corridor, for example. How do you balance that?
Yeah, I mean, in some ways, supply chains are obviously getting kind of more complicated, right, with a lot of tariff barriers and non-tariff barriers. I think what's been interesting is looking at the example of India kind of within the global metal supply chain, right? That really there has been a focus on policy of trying to reshore some of the manufacturing business in India. And if you take the example of solar module production in India, right, which is again probably the biggest driver of industrial metals demand right now is solar module consumption, right? India kind of went from producing basically no solar modules a couple of years ago to now being the second biggest producer of solar modules in the world as a result of this policy change, right? And from a world where people are trying to look to secure supply chains, that seems like a successful policy for India, right? Now, from another bottleneck perspective, like yes, when you're looking at new mining projects worldwide, not all of them are going to be in the same jurisdictions that people are used to. Right now, most of the growth in copper demand, in copper supply over the last few years has not come from Chile, but has come from the African copper belt, right? So these are places that don't have necessarily a lot of inbuilt logistics to begin with, and require kind of more than just development of the mine, but also development of kind of local infrastructure to end up being able to bring this product to market, right? So good examples of infrastructure projects that also help bring this mine supply online are things like the Lobito corridor that is not only then supplying investment in the mines in Africa, but also providing a way for this commodity to then find access to the market in a affordable and efficient way.
How do you see that going? Do you see, in terms of, because the Lobito corridor is interesting in terms of the supply chain for critical minerals that, it is partly financed by the US government. Do you see, both, the Indian government sector, but also the private sector in India taking more strategic stakes in unlocking some of these critical minerals to gain access in the future?
Sure. This critical minerals, the economic importance of critical minerals, along with that, there's the political importance of critical minerals has become more, or even at least equally important. So, who knew that rare earth will help a country to make a deal with US? Even a country is becoming on first sale just because of the availability of critical minerals. And for some countries, it's becoming a first line of defense for the trade war. So along with the economic importance, the political importance have become so critical for these critical minerals. And we have to play within that. There's also the urge for developing the downstream value addition within the country. And some countries have restricted the export of those minerals, but it is for the common goods, common development. So the restrictions in the cross-border trade, that needs to come down. And India is actually going in that direction in this year's union budget. Honorable Minister Finance Minister has reduced the import duty or eliminated the import duty on the scraps for the critical minerals. And the previous year's budget, she already eliminated the customs duty on those critical minerals. So that is in the right direction, so that the domestic industry is able to source it, because India is predominantly dependent on the import for these minerals. That is going to add value to the downstream industries. And Of course, the trade sections, so we need to play within that, and the FTAs which are coming up with the bilateral and the multilateral treaty. We need to utilize all those treaties so that we can diversify our sourcing strategy. So if it is not available in India, we can have a tie-up with Chile or Peru and source it from there and add the value over here. So I think that's the way to not only develop the ecosystem within the country, but take the route of collaboration so that the entire value system can be more sustainable and robust.
So we're coming up to time now, and I have promised to keep us on schedule for this afternoon. But just to finish, instead of putting you all on the spot and asking for a forecast price for next year, which I know everyone loves when we talk about oil, great for headlines, talking from this perspective as a news journalist here, I'm going to ask you, what's going to be the hot critical mineral next year? Is it cobalt? Is it lithium? Is it copper? Is it zinc? Is it nickel? Gouranga, you first. Which one?
My bet is copper.
Copper. Henry?
Yeah, I think my bet's also copper. Yeah.
Siddharth?
I think I won't be the outlier. I'll go with copper as well.
So it's unanimous for the critical minerals panel this afternoon. Copper is going to be hot in 2025. You've been great. Thanks you very much, panelists. Fascinating conversation. I hope all the audience have found this informative. And thank you to the organisers. This has been a great event. Thanks very much.
Thank you. Thank you.
Thank you.